Welcome to the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoan. In today's episode, we have a lot to cover, so let's dive right in. We will start with the weekly Mortgage Digest. The Bank of Canada has raised concerns over economic risks as inflation nears its target. The Bank of Canada recently released a summary of deliberations from its July 24th monetary policy meeting. This summary reveals a growing concern about downside risks to inflation. While inflationary pressures are continuing to ease, as of August, headline Consumer Price Index inflation reached the central bank's target rate of 2%. The Governing Council noted that weak economic activity could push inflation below its target if not carefully managed. The meeting summary indicates that some Governing Council members believe the risks are balanced, with strong shelter and services price inflation countering the downward pressure from excess supply in the economy. However, others are increasingly concerned about the downside risks to inflation, particularly if economic activity and the labor market weaken further. Weak household spending, soft residential investment, and a slackening labor market are placing downward pressure on inflation. Some members are particularly worried that economic activity and labor market conditions may not improve as expected. If businesses delay hiring or investment due to low demand, inflation could drop faster than the bank is aiming for. As a result, the bank decided to reduce its policy rate by 25 basis points on July 24th to 4.25%. They acknowledge that future rate cuts are likely necessary, but they emphasize that there is no set path ahead. The Governing Council members agreed that if inflation continued to ease as expected, it was reasonable to expect that the policy rate would decline further. Indeed, inflation did continue to fall in August, which supports growing market expectations for 2 additional rate cuts at the bank's remaining meetings this year. There is also speculation that one of these cuts could be more aggressive, potentially a 50 basis point reduction, depending on the evolving economic outlook and the severity of the downside risks. The Bank of Canada discussed 2 possible scenarios for the economy. In one scenario, lower interest rates could spur economic activity, and the economy could rebound faster than anticipated in late 2024 and into 2025. This could lead to a stronger housing market, higher shelter price inflation, and sustained wage growth, which might require the bank to slow the pace of future rate cuts. In the second scenario, the economy and labor market may not pick up as anticipated or could weaken further if consumer spending and residential investment remain sluggish. In this case, the bank could be forced to lower interest rates more quickly to offset the downturn. Builders across Canada are celebrating a recent decision by the federal government to raise the dollar limit for government-backed mortgage default insurance by 50%. This marks the first adjustment to the cap since 2012, a move seen as necessary due to the rising property values nationwide. The announcement was made on September 18, 2024, and has been met with widespread approval from the building community. The new cap is expected to provide better access to loans for home buyers, particularly in high-demand markets like Toronto, where detached home and condominium prices have been steadily increasing. The Canadian Home Builders Association, CHBA, has praised the government's decision, stating that it will help more Canadians achieve home ownership. Kevin Lee, CEO of the CHBA, noted that the previous cap had become increasingly restrictive as property values soared. This adjustment is long overdue and comes at a critical time when the market needs it most, said Lee. Rising property values have made it difficult for many Canadians to qualify for mortgages under the old insurance cap. By raising the limit, the government aims to alleviate some of the financial stress on prospective homebuyers. The move is also expected to stimulate the housing market by making it easier for builders to sell new homes. The new cap is not just beneficial for homebuyers, but also for builders who have faced challenges selling properties in a competitive market. With more buyers now able to secure financing, builders can expect increased sales and potentially faster project completions. Economists and industry experts are also weighing in on the potential impacts of this policy change. Some believe it could lead to a short-term boost in housing demand, which would be a welcome relief for builders and developers. However, others caution that it could also contribute to further price increases, making housing even less affordable in the long run. The federal government's decision comes as part of a broader effort to address housing affordability issues across the country. Alongside raising the mortgage insurance cap, other measures are being considered to increase housing supply and improve affordability, including incentives for new construction and reforms to zoning laws. As we continue to monitor the impacts of this policy change, it will be interesting to see how it affects both the housing market and the broader economy. For now, builders and homebuyers alike are hopeful that this move will provide much-needed relief and support. Luxury real estate markets across Canada are showing consistent trends as buyers remain selective and patient, according to the 2024 Royal LePage Carriage Trade Luxury Market Report. The report revealed that while overall sales of luxury homes increased in most major Canadian cities during the first 8 months of the year, prices in the high-end segment have remained relatively stable, with fewer dramatic peaks and drops compared to the mainstream market. Homes typically trade hands at the high end of the market at a slower pace than we see in the industry overall, as the funnel of potential purchasers narrows as the price of properties climbs, said Phil Soper, President and CEO of Royal LePage. This affords luxury buyers the luxury of acting more deliberately, taking their time in a quest to find exactly the right home. Soper noted that despite varying market conditions across provinces, the dynamics of the luxury real estate market are consistent coast to coast. Buyers in this segment are selective and less likely to rush into a purchase. While sales in the luxury market have seen gains in cities like Winnipeg, Edmonton, and Calgary, the most expensive markets, Vancouver, Toronto, and Halifax, saw fewer transactions. The Prairie provinces recorded some of the strongest sales growth in the luxury segment, reflecting the resilience of their overall real estate markets, especially in Alberta, which continues to attract buyers from out of province. Quebec City also experienced a significant rise in luxury home sales. Despite this increase in sales, price fluctuations have been modest. Some regions posted slight price increases, while others saw small declines. Royal LePage predicted that the fall market will remain active, driven by consumer confidence in the stability of the housing market. According to Royal LePage's regional luxury market experts, buyers in this segment are highly discerning. The decision to purchase is influenced by more than just location or amenities. Confidence in the economy and future housing prices often drives decisions in the luxury market. Luxury buyers typically have the means to be picky, Soper said in the report. Their home buying decisions are shaped by more than the desire to live in a particular neighborhood or to enjoy very specific high-end features and amenities. Often, their decision whether to buy or not is driven by their confidence in the health of the overall economy and the direction they see housing prices headed. Our research shows those in the higher end of the housing market have a very positive outlook on the long-term stability and appreciation potential of Canada's housing stock. In regions with high construction costs, the demand for fully renovated turnkey properties is increasing, while in others, buyers are willing to invest in custom-built homes despite longer timelines and higher costs. Additionally, luxury home buyers are generally less affected by rising interest rates, unlike the mainstream market. Many buyers in this segment can make large down payments or pay in cash, reducing their need for high-leverage mortgages. Many buyers in the luxury market segment do not require high-leverage mortgages, where the amount borrowed relative to the value of the underlying property is large, Soper added. In fact, it is common to see expensive homes purchased with very substantial down payments or even fully in cash. With consumer confidence high and a positive outlook on long-term housing appreciation, the luxury real estate market in Canada is expected to remain stable and active in the months to come. Now, let's move on to our final story for today. This one is about a young family who faced the challenges of being outbid on large houses near High Park in Toronto and ultimately chose a rebuild option. In the competitive Toronto real estate market, this family had their heart set on a large property near good schools in the High Park or Roncesvalles areas. Despite having a budget of $2.5 million, they were outbid on all their favored prospects. This led them to switch their strategy and make an offer on an aging bungalow, with the intention of creating a modern infill home. Without competition from other buyers, they were able to negotiate a deal and managed to whittle the price down by $22,000. The final selling price for the bungalow was $1,577,000, slightly below the asking price of $1 million, $599,000. Their buyer's agent, Newtan Brown of Royal LePage Terequity Realty, mentioned, "For almost 2 years, we looked at a variety of homes, but nothing was quite right, so this presented them with an opportunity to create what they want. We didn't have to compete, so we were able to negotiate the good old-fashioned way." The bungalow, located on a premium street in the High Park Roncesvalles area, offers 1,038 square feet of living space. It includes separate living and dining areas with hardwood floors, 2 bedrooms, and a remodeled 4-piece bathroom. New kitchen appliances were installed in 2022, adding to the home's appeal. The property also features a laundry room at the rear, which has an exit to a north-facing deck, patio, and yard with tall trees. Additionally, there is a garage off a mutual driveway on the 30 by 126-foot lot. Newton Brown highlighted the attractiveness of the property, stating, "It's on a pretty premium street in the High Park Roncesvalles area, so the homes are all pretty grand and on nice-sized lots. This is a great rectangular lot with no irregularities." This story illustrates the flexibility and adaptability required in today's real estate market, particularly in competitive urban areas like Toronto. For buyers who are persistent and open to different options, there are still opportunities to find and create their dream homes. And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. Thank you for tuning in. I am Steve Hamwin, and I look forward to bringing you more updates and insights in our next episode. Until then, stay informed and make well-informed decisions.